Welcome to BTFD TV. My name's Jack Barnes, and this is the Macro Tourist Hour. And normally this is where I turn to our one and only Uncle Bob, and we talk about politics, but Uncle Bob has taken the week off, much like I did 2 weeks ago. So we have Millman, the one, the only, not really. He's not in the room. But we have the one and only Sapien, who will be joining us later. And we have Adam, a first-time guest, joining us. And I'll just go right to you, Adam. Welcome to the Macro Tourist Hour. I want to welcome you and tell us a little bit about yourself.
Sure. Thank you very much for having me. Long time listener, first time caller. But yeah, My name's Adam. I live in Portland, Oregon, and I am a former floor trader, market maker for a few large public firms. So my main interest is in derivatives, and now I manage money, basically, my own money as well as some family members and friends. Really a small amount, and I focus on macro stuff. As well as individual equities and indices, whatever, I'm pretty opportunistic. So yeah, that's my story, man. I'm just trying to make a buck like the rest of us.
All right, well, welcome. On the macro side, are you an FX type?
I am. I don't. For me, I have to kind of, there's only so many. One thing I've learned in my trading is there's been times when I think I've spread myself a bit too thin, looking at too many things, and so really I watch the dollar, I watch the dollar yen, I watch a couple other pairs, but for the most part, I, like a lot of people, I've had my eyeballs on the the U.S. dollar and the yen's insane weakening over this last period of time, and
Did you notice what happened in the euro today?
Yeah, it fell off a cliff, which is pretty interesting.
By the way, I'm on record historically multiple times for being a parody guy. So I'm not going to go on record this time because I'd actually like to see it versus calling it and then it never happens. So this time I'm keeping my mouth shut on the P word
Right.
from my own calling it perspective. Having said that,
Draghi likes that, though. I think he likes that. That's gonna that's another thing to discuss. I think the whole and it dovetails into the whole QE thing in Europe. It's interesting to think about what's going to happen there, because the issue with Greece, as well as of course Germany is not necessarily interested, and so what sovereign debt is the ECB going to buy? Are they going to buy Greek sovereign debt? I mean,
well,
I don't think so. Or are they going to leave the eurozone? It's all these crazy things.
Here's another one with these interest rates, like Austria, which is now negative
Yeah.
in portions of the curve. In fact, I believe I have a chart I can bring up with global rates on it, and so I'm going to try to share that while we are talking.
It's amazing. It's
I never in my career did I ever expect to see something like this.
it's amazing. I was just looking
So
at a chart like that yesterday too.
here we go. So taking a look at Austria, it's negative at the 4-year, right? You got to go 5 years out in order to get any rate of return on Austrian bills, and this is a country that's extremely exposed to Russia, okay, and in context, say, Eastern Europe. So this is a country that could blow the F up, the F in our name, right? And as a country, not a company, a country. and instead their rates are negative. Belgium is negative through 3 years. And then you take a look at Brazil and it's 12%, right?
Yeah.
So there's a differential.
Well, right. I mean, I think that there's a little, there.
That's the ECB at work.
Right. Like that's. I mean, Brazil is a little more realistic perspective on risk. You know what I mean?
Take a look at Denmark. I mean,
Amazing.
Denmark. Why in the world would anyone be paying negative rates to put their exposure in Denmark bonds?
It's happening. It's happening everywhere, and I don't know. I just think that
Germany's negative at 5 years now. Did you ever think you would see sovereign negative debt?
I never did. I never did, and it's amazing to me. I remember back when I was, of course, and this was 10 or so years ago, just being on the floor of the bond pit in Chicago, and the Fed hiked rates 50, 75 basis points on the regular, and you know what I'm saying? The market digested it, and
wait a minute. Are you talking about, what was it, '07 and the 75 basis points around January?
No, this was
the gerbil event. The gerbil in ShockGen.
Oh, that's right. That's right. This was a little bit before that, but my point is just that it's amazing the new paradigm of just ZERP, and like everywhere, and I mean I don't even know if I mean it's amazing to me. It's like I could never really think that I could actually think that I might not see 4% interest rates or something again in my lifetime, but somehow it feels like that. I mean,
let's put it this way: Italy. So, quick couple of data points about Italy. A lot of debt.
Yeah.
Some of the least worked hours as a nation. The most unproductive workforce in Fiat's global bank of employees from around the world, including America. They're the most unproductive. In fact, Fiat talked about laying off every single Italian employee. Just yeah, we have the name of Fiat, but we're not going to employ them anymore. But Italy is literally 6 years. You're not even getting 1% to be exposed to a country that's in debt and doesn't work and is one step behind Greece, in my opinion.
Yeah, I agree. I mean, Spain is not far either. It's gotten better, but it's amazing to me. And yeah, Japan. I mean, Japan.
Okay, shrinking population. Let's just take a look at that, right?
That's their problem. They have a major demographic problem, and they're completely monetizing their debt. And
100% monetization.
The experiment is completely failing, and a lot of times, I mean, frankly, a lot of people make this point is that the United States or some of these other countries could certainly look like that after a period of time, if these things continue. I mean, I'm of the belief that there's no there's no free lunch. Like sometimes you have to take some pain, and I'm not.
I got one for you. Here's a pain trade. Can you short the 3-year Japan and then theoretically make money?
Yeah, probably can.
Theoretically. All right. So, would you go short the Japan 3-year with the negative rate and go long the Kenya 3-year at 11%. I mean, I trust Kenya more than the Japs at this point.
You know, I mean, it's a nice little spread there. You know, I mean, I don't. You know,
that's the issue. Is if we've reached negative rates, right, on sovereign debt, doesn't it make sense to actually short them because you get a positive rate?
Yeah, exactly. No, that's exactly right. You know, you get the inverse, which is mind-boggling to me. You know.
Okay, so you get paid to short a national currency now, and then take that over and put it in a country that actually has some growth or at least some attempt of playing the game still.
I don't know. It's totally wild. It's just it's gotten totally insane. I mean, do you see? And it's interesting. You know, of course, I'm reading Jim Rickard's book right now, The Death of Money. Who I know he's been a guest and a friend of this show, and I think he's a really smart dude. You know, the book at first I thought, and I'm not so far into it. You know, I was expecting a little more kind of the conspiracy theorists, like you know, heavy gold bug sort of talk in it, but it's pretty balanced and really interesting. What's up, bud? She'll be back in just a second. But you know, I think it's interesting. A lot of these people have just been so wrong, and it's amazing to me. Like the dollar, you know, I mean, the dollar's got room to run. Hang on one second.
Yeah, it does.
Yes.
Yeah, no worries. That's the beautiful thing about this show is that we shoot it live, we shoot it without script, and occasionally our family join us on air, and that's kind of how the show rolls. In a few moments, we'll be back.
Okay, I'm back.
So, all right, yeah, and he's back. So here's one now that I want to throw out there. Let's take a look at crude. Okay. I've been a bear in crude for a few years. Any of my prior shows, you can usually see me pounding the table.
Yeah.
This is back when it was 100.
Yeah.
I've not been a fan of crude.
Short crude made my year, man. No doubt. It made my year, that trade. Absolutely.
So here's where I think obviously the meat of the move is well done.
Yeah, I agree. I think that the easy money's been made on the short side. In my mind.
I'm going to go so far as say 42 to 46 is the bottom in this move for me.
Yeah.
And that is the top of the Gulf War 1 bounce. That was the pressure point around 91 or so. And I think that it can come down and hit that and then kind of bounce along there. We've been joined by Sapien himself. Sapien, I was just moving on to commodities, but we can come back to fixed income. Do you have any comments you would like to add about sovereign debt at negative rates and shorting sovereign debt to get a positive carry? Well, he's here, but he's not here. There he is. Sapien, can you talk?
He's muted.
I'm still not muting him. He came back, so he would not be on mute at this point. He's muting himself.
Yeah, exactly.
Sir, camera to you.
All right, can you hear me now?
There we go.
Yeah, I'm sorry. This stupid thing's headset is broken.
Thoughts on negative sovereign debt yields and the idea of shorting sovereign debt to get a positive carry?
I think I just don't see a reason why the particular sovereigns that have negative yield are going to get any better anytime soon, because you have on the horizon, you still have a tremendous flight to quality. You still have the specter of Russia blowing up. You have the specter of Venezuela blowing up. and I have enough grit.
Yeah, Venezuela we haven't even gotten to yet. Continue.
And you know, and frankly, you know, I see some other, you know, I see some other oil-producing nations looking a little bit more troubled, especially since they don't have reserves like they should. So for me, I'm not so worried about. I wouldn't try to short a negative yield because that's a flight to quality play. And with so few nations that I would feel comfortable that, hey, they're going to be stable over the next, you know, 9 to 18 months, I would probably not do that. But then again, I don't have any money in the game, so you know what I think is irrelevant. If I had money in the game, then maybe I'd be a little bit more intelligent.
All right, so switching to Venezuela quickly, since it was brought up, it appears that there is an authentic, full-blown supermarket run now. They're emptying every warehouse. The president got on an airplane and he flew to China to ask for a check. They've robbed from Peter and Paul for so long.
Yeah, begging OPEC to meet, you know, to decrease supply. So yeah, that's a mess.
And I think China's the next place that we have to watch. I mean, yes, they've done a fairly good job of shuffling the deck chairs, but at some point, all that water is going to bring down the entire ship. And I just, you know, they still have the ghost cities. Production is coming down. I mean, you know, one thing that I don't.
Rolling defaults have started now, and they're accepting them. They're just quietly letting them happen now. I believe that we are all right. So I'm going to go back to the premise of the lava lamp. In the global economy, there's only room for one nation to be really warm. At any given time, there's one economic bloc. When I say nation, I'm talking economic blocs: the U.S., Europe, Asia, South America as a group, maybe. And they're either warming up or they're cooling down. So there's always one that's warm, one that's always cold, and one that's either getting warmer or colder that's falling, right? And in about '05, we basically had all of the economic groups warm at the same time. We then had our crisis. We've gone through it. And at this point, the U.S., first into the crisis, I would truly say first out in real context now. We're moving on to other aspects of economic implications. They're still dealing with the implications of the crisis from 5 years ago in Europe, in real terms. They're still talking about ECB, you know, borrowing or buying bonds to stimulate things. We're trying to unwind that at our end, right?
Yeah.
So in those contexts, we've come out of the dark tunnel. We're the economic bubble at the top right now.
Right.
And you have nations like Russia, Venezuela at the bottom, and you have commodity-reliant nations like Australia and Canada that aren't enjoying their moment, I think, in the column of heat. And there's probably other nations that are warming up. This is, I think, standard, natural, normal economic reality that rarely happens because we got everyone in sync in '05 from cheap money from the Fed in what, '01, '02, when they tried to unwind the NASDAQ issue, which goes to an argument, and you may know this, Sapien. Arguably, the Federal Reserve has not ended emergency actions theoretically since the was it '98 when we had long-term capital, and they instigated some emergency procedures that were carried through into the crisis of NASDAQ, and then after that, here we are.
Okay, so it's not long-term capital. It was the Russian currency crisis when oil dropped, and long-term capital had gone out of their wheelhouse and doing things that they shouldn't have. So let's just be clear that this wasn't long-term.
They were a victim of their own success, and it was a Russia-driven implication to start. Is that what you're saying?
Explicitly, in fact. So and the noise you hear is my dog going crazy. So I apologize
We
for
don't hear
whatever.
it. We
All
don't
right.
hear it.
Well, at some point she's going to. So
No
just
worries.
because she is, 71 pounds of poor manners. Um, so but I think they've done different things for different crises, and I mean they didn't really do QE in '98, uh, although well, they didn't do QE in '98, and I don't necessarily, and certainly 2004 through 2005, you saw the Fed making a weakish attempt to slow down the economy. I mean, they really should have jacked up rates, and they didn't because at the time with the powers that be that there was no desire to slow the train down, even though it was clearly heading towards a cliff. Um, so when you take a look at it, I mean, there were some things, but I don't think they particularly did it. I mean, it's not until you really the real emergency stuff were, QE 1, 2, 3, 4, choose your number.
Yeah.
Or the QE that never ends. I think that's a new movie by Disney. Um, the, I know I'm gonna be getting hate mail real soon, or hate tweets, for all 5 people watching this. The 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 and then of course the George Bush slash Barack Obama
Handoff.
well, the mediocre stimulus package, right? I mean, let's face it, 770 billion on a $4 trillion economy is sort of like saying, okay, I want to restart the heart, but I'm only going to use I'm only going to use a 9-volt battery.
We'll use capacitors. We'll crank it up.
Oh, thanks. You're making me feel much better now.
All right, I think. Let's bring this full circle to commodity prices, crude, which was where we were picking it up a few moments ago. I'm calling 42-ish, might be 46, but 42-ish is probably the bottom in this real move. Having said that, if in fact nobody blinks, we could have oil in the 30s for 5 years, and I don't think people are really prepared for that.
I don't think they are at all. I have a buddy who trades energy credit, and he says that he's told me that the spreads now are blown out, just like it's like mirror image of how it was before the 2008 crisis, and I think that this whole thing, especially if oil stays here or goes lower, it takes time for a lot of this fallout, and I've heard from some people who have heard from some people in the Bakken that say that people are being laid off and things are starting to happen, that
it's not going to constrict supply overnight.
Right.
You're looking at an 18-month squeeze that you're week one into.
Right, exactly, and I think that I don't think that people are really understanding the gravity of that, like especially with the amount of jobs, etc. that industry has brought, has started in America in the last 5 or 6 years.
This is all the fracking stuff. I'm sorry. Is this
Yeah.
all the fracking stuff?
Right. Yeah. Absolutely. All that stuff, and I think that, and also, and more than a lot of other industries. I mean, those guys use leverage and debt like mad. I mean, it's really it's how the whole thing's done, and I just see it kind of I think it can get ugly going forward, and I think that people don't really realize that. Everyone's focused on, oh, okay, yeah, sure, lower oil, it's great for the consumer, and my gas is cheaper, etc. But ultimately, for the economy, I think it's going to have some pretty serious consequences but it's going to take time for it to play out, if
But
it actually does.
well, I guess this is an interesting question, and this is something I've thought about, and I'll throw it to you because I don't know, and it's just something I've been thinking about. Is certainly you're going to see a contraction in the fracking business. You're going to see a contraction probably in the natural gas business up to a point. You're going to see some contraction in the oil world, but that's not the largest part of the economy. But yet, when you have inexpensive gas prices, which is a hugely stimulative effect for everybody else in the economy, plus anybody who runs any sort of machinery, energy prices, so forth. So the vast majority
trucking companies that have to burn diesel, airlines, the trannies.
What? I didn't hear transportation, right?
So you're saying that it could there's a positive that could kind of balance out that negative point
I would actually say that I think the multiplicative effect of lower energy prices will far offset the
consolidation or whatever that might have to happen.
Well, in the layoffs and so forth. Yeah.
Hold on, let's put it this way. We've put, depending upon how you want to define liquids and hydrocarbon liquids, we've put 3 to 4 million barrels a day into the American system that was not there 5 to 7 years ago, right? That 3 million barrels is the equivalent of Iraq, right? At max fucking production, just to put it in context. We're pumping that into our economy. It's still not going away, right? So we get the value-added crack on that when we ship it overseas as a refined product in diesel or in gasoline blending products to a third world nation like Venezuela, which produces it but doesn't have its own refining capacity, right? So that implication isn't going away. When people are talking about, oh, the impact in the Balkans, oh, the pain in the Balkans, yeah, that's for a bunch of, let's be honest with you, a bunch of drug addicts drilling holes in the ground making $100K a year. They're not going to be able to afford their strippers. Okay.
Right.
That's what we're talking about.
That's a huge. Now I'm starting to feel bad about what I said earlier.
Okay, but having said that, the rest of the soccer moms of America just got literally a stimulus plan that is about equal to what the government gave away 10 or 15 years ago to boost the whole economy in a one deal. Remember when, what was it, George Bush used to send you every 4 years a $200 check, and that was supposed to stimulate the economy? Right? Well, my personal family, I don't even think I ever got any of those checks, by the way. I always fell through the fucking hole. Because I was like self-employed, so you wouldn't get it kind of thing. Yeah, I'm like, oh yeah, stimulate me, brother. Anyway, in financial revenue terms, that was a $200 stimulus. We're talking about a $200 stimulus every single month now, right? That, if this goes on for a year or two with low, cheap gas prices, that will have impact.
Yeah, no, I agree. I'm curious about, hey, Jack, can we speak about the equity market for a second? Do you mind?
Absolutely. We can go equities. I can go there.
Well, it dovetails into everything, but it's curious. It's interesting to me that if you look, it's interesting to me how equities have completely decoupled from the decline in crude, which is a major contrast between 2008 when crude traded down to like $32 a barrel, and now
it's $30 and about 35 cents, I think, 32 cents, depending upon where you want to cut it.
And now even the and frankly, I think it's a dead cat bounce, but the the energy companies related to oil or whatever have decoupled and have started to bounce as well.
Sure. Okay. Oh, wait. That's an easy one. That's a really easy one. We had these things called trading desks back then, and there were banks that had desk after desk after desk after desk, and you had them even trading against each other inside the same damn bank, right?
Yeah.
So there was a joke. You got 6 banks and 55 energy desks. Um, they're gone now. Okay, so in '08, we had everything wound up. You had to unwind both Bear and Lehman's bank holdings for all of their internal desks. That's what fucking took so long and was so damn painful and made it so much fun, right? And I made money in '08. I made money on it. I enjoyed that ride.
Bear wasn't unwound. Bear wasn't unwound anywhere near the same way as Lehman was.
No, because JP was able to suck it up. Lehman was the big one that got unwound, but Bear was a road bump in the equity market when it happened. I had fun there. I had one of my best months around there. So I just anyway.
Oh yeah.
Going forward,
miss
we
my
don't
friends.
have the bank debts to unwind. We don't have. That's why you have a decoupling between the energy, crude prices, right, and the S&P 500. They're not correlated this time, nor should they be. Nor should they be. Okay. Secondly, the reason why you're getting love in the equity markets and you're not anywhere else is pretty simple. Okay. What's the yield on the S&P? And it sucks, but what's the yield on the S&P 500 right now?
I mean, what? It's 11% this year or something, right?
Well, no, I'm talking dividend yield, actual cash.
You know what?
It was about 1.2, 1.8,
yeah, something like that.
Okay. We'll call it 1.5, give or take, if you're lucky, for pricing. What is it again in Austria in 5 years of fixed income sovereign exposure? Negative. Well, if you need cash flow, you've got the only place left is equities that pay a dividend.
It's amazing to me though, because I just it's funny because, so for instance, after a year of consolidation, the small caps broke out. And I look at them as leaders because it's higher beta, more risk, it's more of a risk on thing. And I'm like, Jesus, does this thing have another leg up this year? Because for me it's just like nosebleed area. Like I'm looking at other instruments to trade, but I'm not gonna go on the short side against this freight train. But and a lot of people, I'm starting to hear the narrative, and it kind of interests me a little bit, especially depending on if they do QE or whatever, is doing some bottom fishing in Europe. But still, I think that's a little bit more dicey. I just feel like it's I don't know. I know people poo-poo valuation and stuff, but I think the market is fully valued in my mind, which makes me
Yes, but we're driven by risk, right? You've got a risk of Russia doing what in Eastern Europe. We'll just leave it at that. Okay, I'm not trying to make a political argument here. I'm just making a statement that you've got real on the table risk.
Yeah.
You take a look at Western Europe, and it's held together with a bunch of bubble gum.
Yeah.
And lies. Okay,
basically,
so you got real risk there.
The U.S. is the best game in town. That's the deal.
What's the saying? She's the prettiest girl at an ugly contest.
Yeah. It's wild. I don't know. It's this bull market has definitely
misallocations of capital. An example is Petrobras, right, where they had a built-in funding mechanism for handing out bribes to everybody, and it was just part of their budget, and all of a sudden it's like, oh, they haven't released Petrobras's results twice now, and they're now in legal default. They got 60 days after filings. That'll happen probably this week. And then, there's $53 billion of debt, and they're not going to be able to clean that up.
It's funny. I see a lot of these guys that are into, their deal is the distress stuff, wanting to buy Petrobras with both hands. That's not necessarily my game, but there are those, the people that that go in for the distress thing, and I mean, sometimes it works, but I don't know. I don't know about that for me.
So I'm just going to put it this way. I don't see a bottom in crude where things start flying back up in the near to medium term.
Yeah, I don't either. And I think there's been a lot of people trying to catch that falling knife too that have gotten run over. I don't see it either. Like technically, I would have to see some serious kind of basing price consolidation for a period of time to even think about the long side. It's just
so cheap energy in America. Here's a way of looking at it, right? The way we're doing it now, it's going to be cheap for the trucking, which is big in the U.S. It's going to be big for the trains. It's big for the soccer moms. It's also big for manufacturing, and I think what we're going to see in the next 2 years is an increase in significant remodernization of American manufacturing. Because in the U.S., using futures, you could buy 20 years of your energy needs and build out a book of either long-term contracts with the fill directly or even through futures for a few years, right? That the U.S. is cheap energy costs. And now, given a choice, do you want to have your assets exposed to, say, China, which we just brought up earlier, is not showing any signs of getting better? Do you want it exposed to European negotiations with each other? I think that's a word to use. Or do you bring it to the U.S. where you can literally, you've got cheap energy and a stable environment, and no one's going to invade anyone's borders, and quite honestly, the infrastructure, while not great and we like to bash it, is better than in most places.
Yeah. No, it's true. It's true. And that is absolutely true. And so I think I think that the bull market
GDP
will continue.
Was it real? Ask yourself this: was the last 2 quarters of GDP real?
Was it what?
Was it real? Yeah, the U.S. GDP. What was it? 5%.
Yeah, 5%. I don't know, man. I don't know. That I'm skeptical about that myself. There's so much variance. Like it seems from quarter to quarter. Maybe it was. I don't know.
Okay, cheap energy. You should be seeing it hit the bottom lines of the cost to ship, the cost to handle things in the U.S. first and second quarter. So we are queued up. The 5% caught me by surprise. I thought that'd be more of around first to second quarter, I'll be honest with you.
Yeah, right.
So are we potentially going to be going into June and having a Fed that is looking at back-to-back quarters of 5%?
Well, and then that brings us to the question of it's like are we getting hot a little too quick? You know what I mean? Like,
0 to hot, like in a sauna.
Exactly, and obviously, the inflation fearmongers have been dead wrong forever, and I
was one of them. I was one of them, man. I took my gold beating.
Hey, me too, man. Me too. I absolutely, I really thought differently. I did not expect the level of deflation that we've seen, but I also know that can change on a dime, that would be, because of the lag, that would be something interesting. That would really be interesting to see how that plays out. If the Fed lets it be known that now they are concerned about inflation, and they start raising rates at a much higher
So
higher
all right,
intervals
let's
and
go to
more often.
Sapien. Sapien. Are we looking at what was it, 94, where they raised 8 times in 1 year? Are they just going to incrementally beat us over the head with a quarter every 6 weeks?
The 93, 94. I don't see it.
I don't see it.
I don't see it.
50 bips at a whack, 75 bips at a whack, and you jumper?
No, I don't see it. I mean, first of all, I don't see Yellen doing that. I don't see. I mean, even some of the hawks in the board don't. I mean, honestly, they don't have enough votes to do those type of hikes. Because here's one thing that.
Also, the numbers aren't that hot yet.
Yeah, no, the numbers aren't hot, and let's face it. I mean,
all right. So does the year of 5.0 GDP get us hot?
No, I think if we hit 7 or 8.
Okay, that's what I'm trying to find out, is where's the hot line? I mean, where's it?
Well, I mean, it's
okay. We need to do something.
Well, also, and I'm talking about, and PMI and ISM, all that stuff starts going crazy. Then and 6 and 7%, a few quarters in a row. That's pretty hot. Yeah, I mean that's a stark. That's a major contrast, really quick.
I also wonder, can they really raise rates when housing sucks so badly?
That's another thing. Housing sucks, man. It's getting worse, And I don't know if that's a demographic thing, that's happening. More, less people buying homes, or.
Well, I mean, it's a couple of things, and now you're stepping into an area I know a little something about. When you guys are talking equity, I might as well be staring at a wall because I can barely smell. Right. So, I mean, there's a couple of things going in. Housing formation is still down, so that really hurts the first-time home buyer. You are starting to see the regulations loosening up for the amount of for the down payment aspect of it. You still don't have a subprime market outside of Ginnie Mae. You have a jumbo market, but that's really going to bank portfolios. So the type of liquidity that was in the market, say 2002 through 2007, and part of it, probably inappropriately, that funded a lot of this housing and a lot.
I don't think it's coming back.
There's some structural issues that need to be addressed. I mean, one aspect of it is rating agencies who got roasted over an open flame deservedly are now requiring significantly more subordination rates. There's a better bid for portfolio product than there is for a securitized product. Plus, if you take a look at the Basel III capital rules, if you're going to hold even if you're holding a AAA rated security, you're holding a lot more capital than if you were to hold a AA, a theoretically prime loan, which is more or less AA on your books. Because what people have come to realize, certainly the regulators, is if you're an investor, even though you have that protection, you don't have a lot of options. Whereas if you're holding the whole loan, you have more in the way of risk of loss mitigation, as well as trying to keep the homeowner in the home, fixing it, that type of thing. So, there are a lot of structural issues that are going to prevent housing coming back from any time soon. One thing that I'm concerned about, and this goes to the new house formation, is the overwhelming, incredible student loan debt that's out there. Everybody's getting student loans. When people couldn't get jobs out of college, they said, all right, fine, I'll go to graduate school, I'll do this, I'll do that, I'll do the other thing. They funded that through debt. That's debt that cannot be discharged through bankruptcy. It's
bigger than the home debt in America now, isn't it?
I believe it's the biggest debt. It is the biggest single asset debt. I believe that to be true. I don't know that. When did you go fishing?
I believe that to be true too.
When did you go fishing? Did that have just? I mean,
I've been wearing it the whole show.
And I just noticed. So you're trying to cover your bald head?
Hey, I shaved my head, so yes, I am.
Nice.
Oh, man.
Hey,
You gotta stay away from those $4 haircuts.
I have to break away early today. I've got my kid here, and I have to go handle him.
No worries,
So
no worries.
I-
In fact, we'll wind this one up. Adam, I want to thank you for joining. Go ahead.
Oh no! Just thank you for having me. I'm sorry to have to rudely leave, but you know the kid, you know he's getting into something that I need to deal with. But
we understand that. So let me do my 10-second goodbye, and we'll hit the off button. This is the Macro Tourist Hour. I want to thank our guest Adam for joining us, and the one, the only Sapien for wingmanning with me in place of Uncle Bob, who missed one of his first episodes in like 3.5 years. On behalf of the team and the table, we want to thank you for joining us. We'll be back again soon. Adam, you're always welcome. Please return again soon, and we will pick up our conversations. On that behalf, folks, my name is Jack Barnes, and I want to thank you for joining us. Have a great week out there.